Samsung and SK Hynix are the two memory makers. DRAM is like gold at the moment. It's so scarce, and it's just driven the market up 50%. So it's basically a random factor out of the control of the market can move a concentrated market in a material way.
We've had a lot of conversations recently, obviously, about software in general and Microsoft in particular. That is one area where there may potentially be some disruptive properties that might exist.
As long as the gold price is higher for longer, you've just got so much more optionality with something like that. It doesn't have to go and buy a resource base. It continues to have a very significant existing resource base and many of its assets that it can then continue to look at.
So I'm going to ask the PMs to join me now for a conversation where we'll dig a bit deeper into how these powerful global trends translate into some portfolio decisions, risk management, and long-term capital allocation. You obviously know Jacques and Justin already, but let me introduce David Fraser, our chairman and co-founder of Peregrine Capital as well. Guys, if you can join me up on stage. Thank you very much. Just as an aside, I was actually using Claude Cowork last night to build something for me personally, in that my children love YouTube, and I think there's incredible content on YouTube, but the algorithms feed you absolute rubbish. And so I asked it to build me an app that I could install on my television that would allow me to curate what they saw. It would remove shorts and all those sorts of things. And this was kind of a one shot. And I mean, just to be clear, I'm a kind of Control-Alt-Delete sort of oak. Like I don't have any technical skills whatsoever. And the amazing thing to watch it was it initially started on a particular path that it felt would work. It realized that there was an issue with one of the API connections. It rethink itself, solved its own problem, came up with a solution for that, and just continued to run until it got to a solution that worked for what I had asked it for. And it was amazing. I mean, it's just absolutely incredible that a person with zero technical coding skills can build something in under an hour that is super useful for whatever use case you happen to have. So, I mean, I think these things are moving at an incredible rate and will be more and more useful for all of us very shortly. So, I mean, I think from a starting point, Jacques, we spoke about this in the annual letter, and you did briefly mention it in the slides. But can you just give a bit more detail on the kind of store of value thesis and why you think this is an interesting investment opportunity at the moment?
So I think the thing that got us thinking about this last year, Alan, was really how the Trump White House was seeing the role of the US in the context of the world. I think they realized that with the ascendance of China and how fast China is growing, the US will not have the dominance it had over the last kind of almost post-World War II. So let's say the last 80 years. That era was likely kind of come to an end. So they had to reconfigure how the US worked. So bring home manufacturing. That's why they did the tariffs, potentially spend less on defending other parts of the world, make your own military strong, all in preparation for this. I think another key trigger to the geopolitical uncertainty was the Russia-Ukraine conflict. And the fact that Europe froze all Russia's external assets was just such a big deal. And potentially that was the first flag that gold was going to work, because every central bank had to realize, okay, if I have my foreign reserves in another country's currency and there's some kind of other military or Cold War type conflict between us, that country can just take my assets or freeze it. They control their own currency. So we've seen central banks around the world reduce fiat foreign reserves and buy gold. And I think investors will realize that as well. In the last 20 or 30 years, we had this golden age of peace post the fall of the Berlin Wall, where you didn't really need something like gold in the portfolio because there was no geopolitical risk. And I think that has changed now with the Russia-Ukraine conflict, but also, I guess, the US taking out the leader of Venezuela, Trump talking about potentially taking Greenland from Europe, which thank goodness they've now stepped away from. But I think stuff like, let's say, telling Europe you want to take some of their land, I think that's permanently harmed relationships and just massively increased the geopolitical risk. And for whatever reason, gold is the thing people have gravitated towards for 10,000 years as a store of value. And I think in this time, you've just seen central banks do it, you've seen investors do it. So I think when we discussed it in a team, even though we'd historically not really invested here, I think it was by far the best way to hedge your portfolio against an increase in this geopolitical risk globally. And it looks like that trend likely just goes one way to us over the next 10 years.
Dave, maybe you can kind of take a counter here and just run through what you think might need to happen for that thesis not to play out.
Well, I think Trump would certainly need to go to start with. That would be the first kind of scenario. But it is quite difficult to torpedo it. I mean, I think that once you've let the genie out of the lamp, it's very difficult to put him back. I think people have seen that the US is now no longer a reliable partner or someone that can be relied upon for world stability. So I think once you've got to the abyss where a lot of these countries have with the US right now, it is going to be very difficult for them to walk it back. Trump would certainly have to go, but I think even then, it's going to take a long time for people to wipe their eyes and say, well, this never really happened and everything is back to normal. There's just no doubt that what has happened has been absolutely unprecedented. A historically reliable partner has turned coat on a number of its long-term allies, and I think it's just very difficult in the short term to put that genie back in the bottle and move on.
I mean, maybe I'll add to it. The one negative thing is clearly just how far this already has moved in a short period of time. I mean, gold was up like a huge amount last year and silver the same, and the platinum's obviously catching that precious metal move. So what we debate a lot in the office is what is the appropriate weighting in this portfolio given the positive long-term outlook, but again, trading that off against the very significant short-term move we've had. I think we keep trying to look for strategies where you can capture a reasonable part of the upside, but hedge some of the downside. Because even if a trend is right in the medium term, there could clearly be short-term reversals like we had a few weeks ago for a few days.
Yeah, I mean, maybe Dave, leading into that, then we've obviously had a long history of investing in high-quality businesses, great management teams, and holding those investments for long periods of time. Now, obviously, given the cyclical nature and commoditized output of resource companies generally, what sort of lens do you then apply when considering investments in these types of business?
Well, I mean, I think, Alan, the lens is very similar. I mean, I think particularly when we are starting to look, if we decide that we do want some gold exposure, we need to try and pick which is the best company to sort of express that view. And certainly when we researched all the gold companies, we found one listed in South Africa called Pan-African Resources. It was a relatively small gold company. It's got a mixture of surface operations and retreatments as well as quite a few old mines. And what we liked about that, first of all, they had a very can-do and shareholder-centric management team. And secondly, they have a massive resource base. You know, again, I visited one of their mines, Kinross, a couple of weeks ago. This is a mine that was started in the 60s. The shop was built in the 80s. They've taken literally thousands of tons of gold out of this resource. And quite frankly, there's still 50,000 tons of gold still in underground there. So as long as the gold price is higher for longer, you've just got so much more optionality with something like that. It doesn't have to go and buy a resource base. It continues to have a very significant existing resource base in many of its assets that it can then continue to look at. And all of a sudden, you start bringing in $2,000 or $3,000 long-term gold. All of a sudden, a lot of projects that didn't look so exciting or could never have got off the ground, all of a sudden are very viable. And I think that kind of runs into a little bit more of a theme about SA. The fact that we obviously have extracted a significant amount of gold over the last 40 or 50 years, but we certainly still have a lot of gold, and it, again, depends on the price. So I do think that certainly a specific company like Pan-African was exactly what we wanted. If we look at the return, Pan-African is up 300% in the last year. Another company like Harmony, we also think was a gold mine, is only up 60%. So again, it does depend on specifics. Pan-African just came up with a trading update this week. Although the gold price was up 60%, its earnings were up 300%, and its volumes were up 50%. So again, if you get into the right company that's executing well in a good environment, you can leverage that to turn up. So the fundamentals of analyzing a resource company are very similar to analyzing an industrial or any other company. In fact, probably even more so, because a shareholder centricity in resources is significantly more valuable than perhaps anywhere else. And the resource sector has generally been a destroyer of value particularly because of corporate action and M&A. So again, the lenses are exactly the same as any other company to look at.
And then maybe just following on from that again. So obviously the major driver of market returns last year was the resource sector, which accounts for, I think at last year it was like 35% of the overall index. Resources as a part of the market are the thing that can make you look like an absolute genius one year and super unemployed the next year. How do you balance that, particularly as a fund, as a hedge fund manager? How do you balance that? So we've got this thesis, we like the idea, but how do you balance that when you're investing in this sort of part of the market?
Well, I think potentially it does shorten your life. And there's no doubt on that. And again, if we go back a few years ago when we had the Tugela situation, I think it was one that we were absolutely alive to. We read incredibly well. We got out pretty near the top. So, I do feel we do have a track record of looking at these companies appropriately, understanding where they are at the cycle, and having the conviction to exit when we feel that the share is offering sort of full value. Again, position size will be important. It is a position that some of the underlying drivers are out of your control. Therefore, I think managing the position and the sizings of those positions is incredibly important. In other words, don't bet everything on this theme, but have a reasonable and an appropriate weighting in the funds.
Yeah, so for example, on that point, like we roughly 12-13% between the gold and PGM miners in the fund. So that's obviously high versus our own history, but that's still about a third of what the JSE would be. So we decided on that based on what the risk and return profiles we wanted to deliver. We're excited about the opportunity here, but I guess we do care a lot about downside risk. Where the JSE, obviously, I think the one morning it opened down 6 a week or so ago, didn't end there when the gold price was volatile. So it's a much more volatile offering if you want to invest in a JSE index fund. That's not what we've delivered over 25 years. So we're not going to go there, but we're going to put in the right mix where we think it diversifies your portfolio appropriately while capturing a decent part of the upside return, hopefully.
Cool. I'm going to throw an audible here to you, but I mean, Dave mentioned earlier kind of you want to be selling close to the top, but I recall in a investor conversation we had relatively recently with an offshore investor, they asked us the question of kind of who do you look to be the buyer of your ideas when you exit? And so, I mean, it'd just be interesting, Jock, how do you think about that in terms of when something's getting towards fair value of what you believe it to be? Do you want to leave a bit on the table for the next guy because he's got to have a thesis that says, I want to buy it at this moment in time?
Look, that's a very good point. There's got to be enough juice in it for the next guy. So certainly that's exactly what we did for Tugela. I mean, Dave and I were speaking, and I think there was about 3 months left where we thought the coal price could start rolling over soon here. And while the share didn't quite get to our perfect level, we had this 2 or 3 months window to exit, and it was kind of like 10% below our potential best case exit price. And we said, let's just exit there. There needs to be enough. The next guy still needs to think he can make 20 or 30%. Obviously, you end up losing 60%, but like there needs to be enough in it for the guy that buys off you. And look, I think here there's some different tools because it's gold and the gold miners. One thing we've already been doing is kind of after good periods in gold, you can actually buy gold, put options on actual gold fairly efficiently, much more cheaper than on the shares. So one way to do it is the shares, the gold miners that we own, is really just extremely correlated with the gold price. So we try to look for what's the most efficient bang for buck we can get on protection, and adding put options on gold is a nice way to reduce the downside risk while capturing the upside. So while we don't think we're quite at the end, we'll use that tool to try to prevent the temporary drawdowns. And then hopefully we have some sense when the cycle ends. But I mean, that's very hard. We're going to try our best to do it right, but I don't know yet what the indicators will be. You can just trust, like we did with coal, we're going to stay on top of things, keep watching global trends, and hopefully we'll start seeing it a few months before the market and have the ability to hedge or exit a lot of it before the cycle turns eventually.
Cool. And again, the liquidity is always on the way up, so you do need to somewhat exit slightly earlier than you'd think would be fair value. And I think something like Pan-African, it is a small company. It's recently been admitted to the FTSE index. It's now listed on the FTSE main board. It's very close to getting into the all-share top 40. It is by far still the cheapest gold share around. So again, the profile of the company is increasing. It's becoming better covered. There's more people looking at it. It's getting on more and more people's radar screens. They're now going to speak conferences. So I think as the story unravels, we would certainly anticipate that the discount or the rating discount that it's at right now compared to its peer group will narrow, and potentially that could be a potentially exit opportunity for us.
Gotcha. Josie, you going to say something?
I was just going to mention the index inclusion, but Dave's covered that.
Oh, good job, Dave. Okay, Josie. You mentioned earlier that we've seen a number of these hyperscalers spending money like sailors on shore leave at the moment. We are currently, as you mentioned, in the midst of the greatest capex build out in human history. But as an investor, how do you analyze this? So you've obviously mentioned that you're looking to see whether it's translating into revenue growth. But on two elements, so both on the attractiveness of the businesses doing the spending, so the Amazons, the Googles, the Metas, but also in terms of the investment opportunity and the kind of wider AI value chain.
So look, qualitatively, I think these are some of the best businesses that you've ever seen created in the history of the world. I mean, it's by virtue of their market cap, you can see how big and well sort of respected these companies are. But, we think the question you need to ask is whether or not this is a disruptive technological change or something that is more sustaining in nature. So insofar as the capex is concerned and the AI trend, we certainly think that for the most part, this is going to be a sustaining innovation for many of those companies. If you take a step back and say to yourself, well, who's potentially going to be a threat? We've had a lot of conversations recently, obviously, about software in general and Microsoft in particular. That is one area where there may potentially be some disruptive properties that might exist. But for the most part, we think, the likes of Meta, the likes of Google, and the likes of Amazon are definitely going to see this as a sustaining technology that provides a lot more opportunity than threat on the whole. But I think the natural question you have to ask, and Jock touched on it earlier, is if these companies are spending the capex and we are seeing a return on the capex, but it is suppressing their free cash flow at the same time, where's the capex going? And it's very clear that TSMC, for example, is receiving a hell of a lot of their capex. You're also seeing it with the memory players as well as with the storage players in other parts of the world. So we have focused more of our attention to those specific companies. But again, it's one of those, the difficult thing is, how quickly do you ramp up your expertise in something that you haven't covered for a very long period of time? But TSMC is one of those companies where I think, it is a sustainably, competitively advantaged business with fantastic growth prospects at a great price.
I think we were quite nervous about the size of the capex bill about 3 months ago when these larger numbers started coming out, and Meta and Amazon, Google significantly upped their capex. And I was personally very nervous about the size of the numbers, wondering if they weren't irresponsible. But I think what's happened the last month or two is just the feedback I get from our own internal team using AI tools on how much more efficient it's made them, like 2x or 3x or 5x more efficient. Following on X or Twitter, the top developers globally. I mean, there's several coders at OpenAI and Anthropic that said they've completely stopped writing code. They just manage agents. So clearly, we've discovered something amazing here. We figured out how to turn sand into intelligence. And then, you could see here. I mean, this was like probably, I don't know if this was like 30 days of human work we did here in 5 minutes for those 3 apps, right? So it's just staggering. So I've actually changed to the view that it's really positive for companies to spend this large capex, because basically we think there'll be immense value from that and how much more efficient your developers will be. The market doesn't currently believe that, but I think in 6 or 12 months, we hope the market will figure this out. The one area where we have stayed away is software, because if your edge was developing and building the software, I think this demo should have shown just purely developing software is not a competitive advantage anymore. It's too easy to replicate. Obviously, you've still got sales team and you've got kind of customer data you keep, so it's not as easy to switch you out. But pure software companies, I think the outlook is very hard to predict right now.
And then, maybe just following on from that, so you obviously have 2 large players here who are not listed, right? OpenAI and Anthropic. And they do look motivated by, I think by being private, they have the opportunity to chase the kind of AGI God status without looking to, in terms of kind of, are we translating this into ROI? Is that a risk for the other players, or is it something that you think is actually going to translate into good revenue growth even for those 2 private businesses?
I mean, Justin, you can share your view, but I think it's super likely that both of them list in the next 12 months, given the size of the rate of the revenue growth. I mean, Anthropic's put out, they're just doing 10x a year every year in revenue. They've gone from zero, I think it was $100 million, $1 billion, $10 billion the last 3 years. And I think $14 billion now. I think they're going to be $50 billion or something by the end of this year. So the numbers are just plainly too large to stay private. I think they will all figure out that the listed market will love these companies to list. That's where you can raise 50 or 100 or 200 billion. That might be the kind of numbers needed. If 2 years from now they're going to have 200 billion of revenue, you're going to have 150 billion of compute, which is just gigantic numbers. So I think they will probably become part of the listed universe for us to look at, and then maybe some of the normal listed company constraints will also apply to them at that point in time. Obviously, we'd love it to have a wider set of opportunities to choose from.
The other thing you got to think about is they're not always in control of their own destiny. So on the last Microsoft call, they indicated that Azure, for example, would have grown substantially faster had they not allocated more of their internal capacity to their own foundation model building capabilities. So they're effectively squeezing out some of their customers, OpenAI and Anthropic, in order to go and build their own foundation models. And why is that important for them? Well, we've seen what's happened in software over the last couple of weeks. Microsoft needs to participate in their foundation model layer. And you're going to see that with more and more of these companies. A company like Meta is massively advantaged. They do not sell compute to third parties. And because of that, every single cent of capex that they're spending is for their own internal use case. So at the end of the day, Anthropic, OpenAI, they have to beg and plead with all of the big hyperscalers for an allocation of capacity, where Meta, for example, is spending 100% of that on themselves and their own model. And I think if you look at a lot of the sort of data that's out there, having the most compute available is one of the inputs to sort of brute force your way into a leading edge model that has greater capabilities than anybody else. So I think having the cash flows to support the capex is ultimately going to be used to sort of support the compute and drive your own internal model creation is absolutely vital in this year. And that is something that OpenAI and Anthropic do not have access to until such time as they become listed A or start raising capital.
Got you. Josie, maybe just back to you. There were a number of company logos on that kind of universe slide of yours that I must be honest, I didn't know what those businesses were 2 years ago. So maybe you can just talk a bit more about our exposure in that semi space. I mean, obviously discuss TSMC, but maybe just expand a little bit on that.
Yeah, so if you just look at the proportionate exposure in the semi space within the portfolio, 2/3 of that is sitting with TSMC at this point in time. That, again, is the company we've got the most confidence on in the value chain. It is a monopoly. It basically, there's no competition. Nobody else out there in the market can, create the chips as efficiently as TSMC can do. So we really like the valuation. We really like their growth prospects of sort of 35% per annum for the next year. And they are the best type of business to be invested in the world, which is a monopoly with very high barriers to compete insofar as competitors are concerned. The rest of the stuff is largely in the memory and the storage space. If you've covered any of those sectors for a prolonged period of time, you will notice that they are fairly boom and bust in nature. They're very capital cyclical in nature, and we are betting on the fact that the current shortages that we're seeing in the market at this point in time will persist for a prolonged period of time. As our chairman often reminds us, even a turkey can fly in a hurricane. So that's what we're basically sort of betting on at this stage with those specific names. But as you can see, they're only 1/3 of that semi's exposure because we are quite nervous about the potential risks there.
Cool. Okay, Josie, one last question for you, and I promise I'll leave you alone for a little bit. But I have no doubt that in 1999, there was a panel of PMs from, say, Aberdeen or Janus Capital who sat up here on a stage in front of investors like we're doing today and told the very same bullish tech story that we are telling right now, obviously in relation to kind of the internet stocks. How can we be confident that this panel won't age as poorly as it did when the dot-com bubble burst?
So I won't spend too much time on the things we've already spoken about, but effectively biggest build-out in history, fairly well supported in terms of you are getting the ROIs I do think that there are handbrakes in the system with respect to TSMC, and the valuations are quite compelling. But if you also take a step back and say, what other factors are you looking at from a affordability perspective? Are these guys going to blow their balance sheets up? Well, in 2026, all of the capital expenditure that we spoke about is going to be funded with operating cash flows of these businesses. That might change in 2027, 2028, but we are anticipating the revenues and the profits are likely to come for the hyperscalers in particular. And then we have to ask ourselves, what actually happened in 2000? What was the build-out? Was there a capex cycle that took place? Yes, there was. There was a massive capex cycle, but most of that capex was companies putting fiber in the grounds in the hope that people were going to subscribe to the internet, and that certain businesses would be built on the internet. That resulted in what they refer to as dark fiber. It is dark fiber because it is dark. Nobody was using the product. The adoption from a consumer perspective took years and years and years. It ultimately proved correct 25 years later in terms of what was built, but that was the situation where you had a massive debt-fueled capex, which we don't have today, and where a lot of that capex was just sitting idle in the ground. We don't have any idle GPUs in data centers today. Every single CEO of the hyperscalers that you listen to is telling you every quarter that they are capacity constrained. And that has been the same message that we've received from them for the last 2 years. It just hasn't changed. The next 2 years look as constrained as the past 2 years.
The other key thing I'll just add to what Justin says is we've got an internal rule that you're never allowed to fall in love with a company. So we will always look for new information that emerges, and we're just happy to change our minds. Right now, we think I'm with Justin. We think there's the mega trend. There is something that could happen that where we could be wrong, right? Like you can't predict the future perfectly, and we are just so focused on being willing to change our mind when new information emerges. We don't mind talking to you guys about a share or writing in our letter. If new information emerges that disproves our thesis, which has happened for stuff we've written about in the past, we'll just change our mind, sell it, and find a new opportunity, right? So we think the indications are extremely strong right now, and I think this exponential curve you showed of intelligence increasing, we just think that keeps going. But if either models get much more efficient or they stall out, we can see that early and kind of try to change the portfolio in time for that to be reflected in the market.
I mean, also pets.com was...
Oh, what Jock showed you was real, but it was not pets.com.
It was not pets.com from 2000. Okay. Dave, I'm actually I'm going to pivot to you here. You will be speaking very shortly about the impact this will, specifically the store of value kind of thesis, the gold price, the PGM sector will be having on the South African economy. But perhaps you can also just talk quickly here about how we are positioning the funds to take advantage of this theme.
Well, Alan, I think what struck me, I did the graveyard shift over December, so I was at my desk filling my thumbs and started to look at a few drivers of the South African economy, and there's no doubt that the precious metals is very persuasive. And then you combine that with a few other things like a stronger rand, lower interest rates, and there's all significant reforms that we're starting to see pay back, whether it's Eskom or Transnet. It was very clear to me that we were starting to set ourselves up as an economy for great success. Now, again, in times we look at South Africa, we look at the valuations of South Africa, and if we feel on a risk-adjusted basis there's a good story out there, we'll engage with it. And there's no doubt that we felt that certainly the South African story was turning relatively rapidly. And we said, looking at where South African shares were at the time, they were continued to be at very modest PEs. We did start, even at the end of December, starting to increase our weighting in South African-based companies, whether it's banks, food producers, retailers, and we've sort of played that out over the last 3 or 4 months. And I think you'll see from the presentation, when you look at the balance of negatives and positives, for the first time, those positives are really outweighing by quite a significant margin the negatives that are out there in South Africa. And one would certainly hope that as we sit right now, we potentially going to translate this into a pretty good news story for South Africa. I think everyone's had enough of being negative. We've had a windfall from precious metals, and long may it last. But certainly while it does last, it's very significant on South Africa and many economic factors which are kind of working together to get quite a good story out of South Africa. So we definitely have increased our weightings to South African focused stocks, and I think it's something that we have increased pretty significantly in the fund.
So I want to add to that. If you think back to France's slides, he showed business confidence and consumer confidence, GDP growth, a deficit. All of those were the best between 2004 and 2007. It was a glory period for SA. And what he didn't say was it was not because of anything the ANC did right or wrong. It was simply a commodities bull market, and a commodities bull market drives South Africa. And that was the last commodities bull market. It was the initial rise of China when they built all the skyscrapers and the bridges and the roads and the trains, and all commodities were high. And what are we in now? So far, we're in a commodities bull market. So we just think you can both potentially own those shares in the bull market, but then play the second derivative, which is the benefit it will bring to SA on all these points that David mentioned.
And I hope when you all leave today, your own perception of economic confidence will be up a little bit. So we're going to take an exit survey and we'll you find his number starts moving up a bit.
Fair enough. I mean, Jacques, maybe for you, but anyone else that is that has an opinion, we've obviously seen incredible growth in the capacity and the abilities of these models, and I mean, coding's obviously the kind of the sector that has been disrupted so significantly first, but there's no doubt that these things will have a material impact in financial services and in asset management. And we are certainly not going to be immune to their ever-growing impact. How do you think some of this might impact us as a business, and what particular human edge do you think is left for asset managers like ourselves?
So look, I certainly think it's going to impact all industries and definitely asset management as well. I think the goal we've set ourselves is to be the best asset manager in SA in terms of utilizing these tools to improve our investment process, to make our analysts and PMs make better decisions, to better manage the risk in the fund. So we are spending a lot of time and resources on all of that. We're not ready to really go into the details on these things, but potentially 6 to 12 months down the line, when we see you guys again, we might be ready to demo some of the things we do. For now, I think we just want to use them internally, but there is just immense ability here to improve our internal process, to make all the analysts more efficient, to better use the data. I'm just super excited about it. I mean, Justin, I know you're almost giddy coming to work every day, so you can also add to this.
Oh, I don't have much to add from a business perspective, other than to say that, like, again, we come to the office feeling like we're 19 again. We just, I feel so stupid every day, and you just got so much to learn because this technology is teaching you about things that you didn't even dream about in the past. So I think there's tremendous opportunity for the business from an efficiencies perspective to enhance customer experience, to potentially make better investment decisions at the same time. But you've got to be at the forefront of this. You cannot be left behind, unfortunately.
Listen, if it makes you feel any better, I've been feeling stupid every day since I started working at Peregrine. So, but
I'm feeling like I'm early 40s there.
Oh, yes. Okay. So I'm going to finish up with one last question because I am aware that we're running over here. But Jacques, so last year JSE obviously had its best year in 20 years. And I am sure that there are some cohort in this audience who are quietly thinking, I should just buy an index fund and head to the beach. Tell me why you think that might not be the best strategy going forward.
So firstly, I do want to say that the JSE could potentially, if some of these things we're talking about plays out, it could potentially be a good place to invest even for the next year or two. Obviously, it's a very concentrated index, which means it will be super tied to how the store of value piece plays out and whether precious metals stays as in demand as it did last year. And if that scenario plays out, I think the JSE might continue to be one of the best performing indices globally. But you're basically taking a bet on kind of one theme. In the same way, for example, we were talking about in the office, the South Korean index, I think it's up like 50% in the last 6 months. Why? Because Samsung and SK Hynix are the two memory makers. DRAM is like gold at the moment. It's so scarce, and it's just driven the market up 50%. So it's basically a random factor out of the control of the market can move a concentrated market in a material way. So I actually think people should consider having the JSE in their portfolio. It's basically everyone should just decide for themselves what is the appropriate level of risk I want, and that will determine how much you should take on this bet. That's not quite what we want to deliver. We think you build wealth personally and for investors by consistently compounding. So we will try to capture some of this trend, but we'll try to make sure that we also do well if this trend reverses. Obviously, if it reverses, the JSE is not going to basically take those things out the index. You're going to write them down again. So I guess our job is participating in this trend, benefiting from it, but always think about the downside and of the trend changing. But I wouldn't suggest people necessarily go out there and sell their JSE index exposure. I think it's for everyone to decide how much store of value or gold exposure is right for me.
I don't want to scaremonger, but I was having another intimate conversation with Gemini yesterday. I was asking her about the South African situation and, what does South Africa look like in 3 to 5 years' time with the proliferation of AI tools. And the one thing it pointed out to me was that we've got, 1.5 million taxpayers that pay 80% of income tax in South Africa, personal income tax, and that represents 38% of your total budget on an annual basis from a SARS perspective. So Gemini, ironically, was extremely negative about the prospects for South Africa in the context of the AI boom. But when you dig a little bit deeper and you speak to things like gold and platinum and precious metals, then all of a sudden it did sort of prop up, and it was still quite positive about the future. So I think diversification is the name of the game, and we do have to look for different pockets of value where you will be able to preserve wealth and continue to grow the assets for investors.